Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Franklin Templeton's core multi-manager 100% equity ETF portfolio. The objective is quite simple: to provide exposure to global equities and take advantage of the asset allocation skills and investment expertise of Franklin Templeton. So let's investigate in terms of how this model portfolio has done. And we can have a quick look at the holdings, and we do see 7 ETFs. There's only a few of them from Franklin Templeton, so kudos to them in terms of also using external products like from iShares and Vanguard. We do see that the largest allocation is to a US equity index with 39%, followed by a US large cap multi-factor, and then a MSCI alpha exposure. In terms of benchmarking, it's probably best to go to the fact sheet because what we see over here is that the benchmark changed over time. So at the moment, it's a 75% S&P 500, 25% ARCRI ex-US combination, so custom index. Before that, it was only 66% in the S&P 500 and 34% in the MSCI ARCRI ex-US. Now, it's kind of interesting to see an asset manager changing benchmarks. Usually that's not a good sign. And what likely happened in this case is that the S&P 500 just outperformed international emerging market stocks. So investors looking at this model portfolio said, look, we're not happy, right? Seems to be behind the US stock market. Why don't we have more exposure to the US stock market index? And so Franklin Templeton, that's our assumption, they complied and effectively said, let's increase the exposure to the S&P 500 and decrease exposure to international emerging market stocks. Now, ironically, international stocks have outperformed the S&P 500, right, in 2026. So the timing of that benchmark change is a little bit, unfortunate, but that's what happens if you change performance or if you give in to your investors who choose performance. So from a benchmarking perspective, we're going to use the same benchmark. So I created a custom benchmark using 75% for the S&P 500 and 25% to the ACWI ex-US. We do see that if we look at the current portfolio, it's virtually undifferentiated to that custom benchmark. So that's kind of like, not very interesting, frankly speaking. Having said that, that's naturally the performance of just the current holdings. If we do go back to the fact sheet, we do see the actual track record of this portfolio. So this includes changes in asset allocation. We do see a gross return of 8.54%, a net return of 5.39%, but unfortunately, return of the benchmark of 8.7%. So stated differently, Franklin Templeton's expertise with regards to asset allocation has not created value so far. It underperformed. Now, let's investigate a little bit further. So we'll first have a quick look. We've already seen the performance of the portfolio versus the custom benchmark and seen that this was almost identical. Now, if you look at this from a kind of like breakdown by markets, asset allocation, we do see exactly the same splits. So exactly the same exposure US, international and emerging markets, more or less allocations. We do see it's primarily large cap stocks, right, with very little differentiation to that index. From a sectoral perspective, likely we're going to see, very little over and underweights. So you can see, for example, there's a slight underweight in technology, but it's minor compared to the overall allocation. So this portfolio is very undifferentiated so far. We can change the perspective from sectors to factors. And what we are going to see here is, I think, slight allocations to, the value factor, momentum. On the positive side, negative exposure to quality and volatility, and kind of a time exposure to the size factor. Having said that, if you look at the percentage of Equity factors, how much they contribute to the overall risk, is practically zero. This is all plain vanilla equity exposure. And that is what we can explain with this portfolio not being constructed thoughtfully, because what happens in this portfolio, and we've seen this in a number of model portfolios, that funds are being combined that had offsetting factor exposures. For example, over here, we have large cap value, but we also have, well, large cap growth. Now, these are diametrically opposed in terms of the stocks from a characteristic perspective. So, for example, if you look at the quality factor, growth stocks, they give you a positive beta. Value stocks give you negative beta. Low volatility, it's the inverse. For the value factor, it's inverse. So effectively what's happening is factor netting. But if you have funds in your portfolio that focus on large caps, growth and value, that net themselves off, you're just left with plain vanilla equity. That unfortunately also means, right, that this portfolio likely is unnecessarily expensive. I mean, it is cheap with 12 basis points, but you can always reduce fees. And so if we look at this to replace it with passive benchmarks, right? So we're looking at every single fund in this portfolio, and we are showing only passive benchmarks that allow you to have a similar exposure, right, but lower cost. So for example, right, for that Franklin US large cap multi-factor product, you have to pay 15 basis points. From our perspective, it's not very much different to just the Russell 1000 overall. That's 7 basis points. Now, if you reduce or replace all the funds with cheaper kind of ETFs or index trackers, you do reduce the portfolio cost from 12 basis points to 7 basis points, and you get virtually the same performance. And that's from a fee perspective. Now, the other question that we often look at is, can you simplify a portfolio? Now, there's about 7 ETFs in here and 1% cash allocation. In general, if you provide exposure to just equities, doesn't matter if it's local equities or global equities, 7 ETFs is, frankly speaking, too much. And that's, of course, exactly what this analysis shows, right? You can go from 7 funds plus cash to 3 securities, which is just a little bit of the S&P 500 total stock market and the ARCRE. You pretty much get the same performance, right? But it's a much simpler portfolio to look at. And that kind of concludes our review of Franklin Templeton's core multi-manager portfolio. So overall, it's a cheap portfolio, which is good, 12 basis points. There's nothing to argue about that. Having said that, it's unnecessarily complex. It contains funds that have conflicting factor exposures, and you can simplify it into basically 2 or 3 securities. Hope that helps. Have a nice day.